stocks remain caught in a narrow band as optimism on inflation easing competes with fears of a recession. IT and consumer durables in the red, metals notch some gains.
Infosys and HCL Tech report better than expected earnings, but one-off boosts and macro concerns cloud the future outlook for FY24.
L&T Tech too slips as analysts remain iffy on the benefits of its acquisition of parent L&T's next-gen communication business, but MCX gains on hopes of a volume boost from new contracts.
Central bank purchases at their highest level since 1967 and dollar weakness prop up gold prices that flirt with nearly $1,900 per ounce. Several experts see the yellow metal headed to over $2,000 an ounce.
December CPI comes in lower than expected and raises hopes of a pause from the Reserve Bank of India in February monetary policy. November IIP output grows by 7.1%, reduces fears of a deep consumption slowdown in Q3.
Good afternoon. You're watching us here on Halftime Report. I'm Mangla Malu, with me Ekta Batra. It's an extremely volatile, choppy session, what we're witnessing. In fact, we've been seeing that for the last few trading sessions for our market, but it's been in a narrow band. In fact, every time the market goes closer to that 17,800, 17,750 mark, we see some bit of bounce. But every time it goes closer to that 17,900 and a little above that, we see some supply. And in that band itself, we've been moving on. It is the mid-cap index, which is underperforming today with a cut of almost 0.2%. Even though the advanced decline ratio is at an even keel. So markets at midday in the middle of the band that we're talking about, and it's all about the volatility. Hi, Ekta.
Hi, Manglam. Yes, absolutely. Well, for the week, at least at this point in time, it's a marginal cut for the Nifty, so down about 0.14%, but the mid-caps have underperformed with a cut of around 0.8% on a week-to-date basis at current reckoning. Let's see what the second half throws up, but there's definitely some amount of trepidation that despite a lot of the global cues, we haven't managed to take that forward for our markets, and the Nifty is currently down around 20-odd points. But let's talk about the pharmaceutical space. That's been in focus on account of multiple news points in the past couple of trading sessions. Case in point would be something like a Divi's and Gland Pharma, which were down significantly in yesterday's trading session on the back of export data. And we have data coming in from the US that Tamiflu generic, which is basically a drug used for the flu, has seen shortages in the US, and hence that would probably bode well for a couple of pharmaceutical companies back home. Prakash Agarwal, Deputy Head Research Executive Director Pharmaceuticals at Axis Capital, joins in to put the focus on this space. Prakash, hi, welcome to the show. Well, you know, let's start by talking about the flu season in the US. You know, it's definitely a negative for patients and for people there, but it's definitely a positive for a lot of the companies here, the likes of Ajanta, Lupin, Zydus, to name a few. Can you give us a sense in terms of how much it would probably contribute this quarter and going forward?
Yeah, hi, Ekta. You know, there is a flu season that is caught up, and it's not a January phenomena. It's actually picked up in November and December. So you would see some tailwinds in the companies that you mentioned. This would be a good tailwind, especially when the sector, especially the US generic, is seeing headwinds in terms of US FDA issues, volumes coming down, pricing remain a risk. So that would be beneficial to some of the names, I guess.
Okay, so that would be beneficial. But Prakash, you know, the other piece of news that we were working with in yesterday's trading session were the sharp declines that we saw for the likes of Gland as well as Divi's. And there was this export data that had resulted in the downside that we've seen for the month, which would probably indicate how they could fare in Q3. While you might not discuss stock-specific action here, just wanted to understand the correlation between this export data and what we could eventually see in the Q3 numbers. Is this something which was tracked very closely?
Yeah, so export data gives you some reflection. So there is a part of the data which gets captured, but it's not always correct, but it gives you a good direction. And there is an SEZ data which is still due, so that gets added to the overall export data. So this is a good reflection, but in general, if you see these couple of stocks, they have their own intrinsic headwinds. I mean, Divis is now, if you see, they are sitting on a very high base of last year with molnupiravir sales. So they would in general see a decline in the second half YOY. And as far as Gland is concerned, I think they themselves said that, they are going through a weak phase with a lot of shortages, especially on the syringe and stopper side. So until unless those are resolved, the exports is likely to be muted any which ways.
Right. Prakash, thank you for joining in. Let's get stock specific now. We had your view coming in on Piramal Pharma. You've initiated buy with a target of 160 odd rupees. It's an interesting move that we've seen on the stock ever since it's listed at over 200 rupees in October. It's been a steady decline, and it's just the last few trading sessions we've seen a lot of brokerage action taking place out here. What do you think could be the big triggers for them? And I mean, why is it that you're betting on this one as against any other opportunity here in the space?
So as a CRO and CDMO opportunity, we as per our channel checks, that space is looking very interesting. We are seeing a resumption of global research outsourcing coming back. And as China plus one trade, which has taken longer for pharma, and especially for CDMO and CRO, this piece is picking up. November, December is a new contracting cycle, and we hear that a lot of orders, supply orders, etc., which inevitably goes to China. India is now, a big winner there. So we understand that the CRO and CDMO opportunities are coming down to India. And stock specific, I mean, the call has been like, if you've seen the stock in the last 2 to 4 quarters, they are having their own company specific headwinds in terms of attrition, supply chain issues, capacity constraint. And I think companies taking a lot of initiatives to address the same. So we believe that starting from Q3, the second half would be very strong, and it would build on to fiscal 24 with the company initiative like hiring, training, capacity coming back, freight cost coming back. So we feel that these things would reverse, the headwinds would reverse shortly.
Okay, so there is hope. Maybe Piramal Pharma is that dark horse within the entire pharmaceutical space. Would you share the same view for companies such as Divis or Gland, which have been the significant underperformers of 2022?
No, so I mean, there is a little bit of difference between the two. I mean, I think you have to, every stock has a life cycle in terms of performing, and you have a high base as mentioned in Divis. So they have to cross that headwind of second half, and then probably we start seeing some growth in fiscal 24. But we see some headwind coming for Divis in the next 2 quarters. For Gland, as I mentioned, that they have to come across these shortage issues. But Piramal has surpassed these headwinds and now expected to start reporting good growth going forward. We recently upgraded Syngene also. So that is also on the back of the increasing tailwinds, which we can see from the CRO, discovery, development, as well as CDMO, which is more on the development side and manufacturing side. So I think every stock, pharma, apart from being top-down, is also bottoms up. So we prefer names like Piramal or a Syngene versus the other.
Okay, just on that point with regards to Syngene, Prakash, I wanted to get a larger context here, because Biocon has been significantly underperforming. And whereas there's a large part of the brokerage community, investor community, which continues to be very positive on Syngene. But just give us a sense in terms of why there is this dichotomy and what might actually be plaguing Biocon.
Right. No, so it's a fair question. So Syngene is a pure play CRO, and with its Mangalore facility coming in, it's also becoming a CRAMS player going forward. So it is more like an outsourcing theme that you want to play with Syngene. Whereas Biocon is a company of 3 assets largely, with the largest one being Biocon Biologics. So that's more on the play on the biologics, biosimilar trade in the US largely, with Europe and ROW, the other key markets. Syngene is only 20%, 20-25% of the overall Biocon sales. So it is a part of it, but if somebody is playing pure play CRO, CDMO outsourcing, Syngene is the stock to look for, as per our view.
All right, Prakash, thank you so much for joining in and giving us your views on Piramal Pharma itself. You've assigned that, any potential corporate action like a promoter warrant or further infusion by PE to reduce debt could be one of the triggers as well. So apart from their financial performance, we will also watch out for any of these corporate actions taking place out there. That's Piramal Pharma, virtually at the high point of trade, marginally outperforming all the other parts of the market. With that, we'll step into a short break. On the other side, we have the management of GTPL Hathway. Piyush Pankaj joins in to discuss their third quarter earnings performance. Stay tuned.
Welcome back. Well, it's definitely a weak session. We have the mid caps which are underperforming, so down around 0.5% currently for the mid cap index. Just want to point out that the weakness is probably also linked to maybe the FII selling significantly in the Indian markets. They in fact have been net sellers through 2023. Yes, it's just a couple of days, but nonetheless, they've sold around 15,000 odd crores within these couple of trading sessions in the month of Jan. There's not been any kind of net buy figure coming in from the FII still now. But remember that the domestic institutions have been negating a large part of it. They've net bought over 10,000 odd crores in the same period. But nonetheless, this is something to keep in mind. The next stop in terms of cues would definitely be the Fed meet, which is on the 31st of Jan going into the 1st of Feb. And Feb 1st will obviously be a day filled with cues, considering that it is the budget back home as well. So that will be something important to watch out for, and would be probably the next stop in terms of macro cues to watch out for. But let's move on then. GTPL Hathway posted what was a weak set of numbers. The margins for the digital cable TV service provider contracted by around 400 basis points, although they witnessed a rise in revenue from operations. Piyush Pankaj, who is the business head at and the Chief Strategy Officer at GTPL, joins in now to discuss this. Mr. Piyush, hi, thank you for joining in and welcome to the show. If you could just start by talking about this 400 basis points margin contraction that you've seen, what led to it?
See, we are entering into the new market, and we have changed our strategy and going for the consolidation of the market. If I talk about cable market, it's like 45 million subscribers are still with the smaller MSOs, where the quality of services is the issue. And those subscribers are getting churned out from the industry to either to DTH or OTT or free dish and everyone. As a bigger player, we have to consolidate those markets, and we have changed our strategy to go for the aggressive consolidation and go for the acquisitions. In acquisitions, always it happens that the cost comes in the beginning. As you are entering into new market, you have to do all the establishments and everything, and the revenue follows. So this contraction is one of the blip in this quarter, as we have changed our strategy. The revenue will follow, and again, you will see that the margin is going to be at the same level which we maintained from last 5 years. And we are hopeful that that will happen. Already we are seeing the pipeline of revenues which has to come from this new market and this new acquisitions. So we are hopeful that this is a blip for 1 quarter, and it will get recovered from the next quarter onwards. And FY24 is going to be very promising for GTPL Hathway. So we are still making cash flow positive. We are still making increase in the subscriber numbers and everything. You can say the basics of the business is still intact, and we are hoping that we will recover this blip.
So let's talk about a few numbers, Piyush. You said that you are hoping that FY24 would be a good one for you, and things are looking on the mend. Your margins this time around were 16.5%. In the past, you've gone as high as even 27% on the margins. I just wanted to understand, what would a normalized margin, picture look like for you? What kind of growth are you anticipating in FY24? And at the same time, your revenue mix, how will that change in FY24 when it comes to digital versus broadband? Because from the start of this year to now, the contribution in terms of profit coming in from broadband has increased quite a lot. So 3 numbers from you: growth expected in FY24, margins, and contribution.
So in the CATV business, we are looking forward for around double-digit growth, somewhere around between 12 to 15% straightway, and those is going to be contributed straightway into the EBITDA, as we have already put our monies in the establishment's cost and everyone. So that is in the CATV business. Talk about the broadband business. Yes, the growth rate in broadband is higher and it will remain higher. It's a sunrise business, as we keep it as that it's just the start of the whole industry. Only 25 to 30 million subscriber base is there in the wired broadband, and still a lot of you can say it has to grow in quicker manner. And that's why we are keeping that we are going to have between 20 to 25% growth in the broadband business. And our margins, if we talk about, we are again going to get around 20% margin, which is the consistent margin if you see from the last 5 years from there, that we have gone up to 27% because that was, you can say, those quarters were very good. And again, we have come to the normalized period. So 20% margin is what we are looking forward to, which we maintained from last 5 to 6 years. So that is the case, yes. Both the CATV and broadband, we are looking forward that the growth will be there. And the consolidation in the market is happening, which is going to help the bigger player.
Okay. Can you give more details with regards to the broadband business, which you indicated is a sunrise sector for you? In terms of the average revenue per user, that's currently at around 455 odd rupees. There's been a marginal move up if you compare it to the previous quarter. Where do you think you can probably push it to, as well as maybe subscriber addition on a quarterly basis?
Yeah, so if I talk about my subscriber additions, gross subscriber base, we are keeping it around 70 to 80K per quarter. Some quarters shows higher churn, some quarters shows lower churn, based on the when the examinations are there, based on the quarter basis that that period comes. But we are keeping that we are going to increase every year around 200K to between 250K, the net subscriber base, which will go up, and that's going to contribute in the revenue side. ARPU side, we are keeping that ARPU is going to increase slowly, 2% to 3%. That's the target we are taking in the ARPU, as we are going into the volume game rather than the value game right now. And you have to increase your service qualities. You have to layer your services as we go forward. And through the layering of the services, you will get more and more revenue. Like you start the security services, financial services, start integrating the entertainment, broadband, and OTT together, all those things together. So whatever customer wants, he's getting on that way. That's the convergence side, which we are doing it, and increase the ARPU, or you can say increase the margins through the layer of the services, where you will get more money for providing more services on that case.
Right. You know, and finally, before we let you go, you have given us a sense of what business is likely to grow at, the rate at which subscribers will grow, the ARPUs, etc., and the fact that there is consolidation between MSOs and smaller players. What has happened over the last couple of years, the biggest significant change was the change in ownership. How have things changed with Jio as a promoter? I mean, have you seen any upselling, any synergies? What kind of growth can you expect, primarily because of the change in promoter? I mean, how have things changed for you?
It's very positive for us, you can say, because Jio being our promoter and partner, all the knowledge transfer, the vendor negotiations, wherever you need the help in the industry, you are getting that. And so all type of help we are getting into that, and positive, very positive impact on our business. They are giving us the freedom to do our strategy, go on our strategy, make the money. And wherever we require the help, they are providing us. They are providing us the guidance also.
The reason why I ask you this is there a possibility, Mr. Piyush, is there a possibility of collaboration, a merger of all the companies?
See, it depends on the strategy as we go forward. If we collaborate, it's going to be 20 to 22 million subscriber base straightway. Yes, we are getting those benefits as we are doing the negotiations as the together, all the companies under the umbrella. All those synergies we are creating. But yes, the structural changes and all, that is going to help the whole industry. As the industry is going forward, you become a formidable player in the market on the consolidation, and you will see more and more players coming to you for the acquisition, smaller player and all. So yes, it is going to help us, and we are already started taking the steps operationally on those sides. We have to wait and see that how the future unfolds.
Okay, all right, Mr. Piyush, we're going to leave it on that note. Thanks very much for joining in and speaking with us. So that's GTPL. It's been a bit of an underperformer, not only today, but in the past 6 months odd, it's lost over 15% in terms of market cap. We'll take a short break, but before we do that, here's an important piece of information for our viewers. Don't miss out on the 19 must-have stocks for 2023. Subscribe to Money Control Pro to get the full list.
Well, it's a swift and a smart recovery that we're seeing for our markets. In fact, the Nifty is now back in the green and inching towards the 17,900 mark. From the lows of the day, it's recovered about 120 odd points. What's aided this recovery in the last few minutes is, one, the IT pack moving off lows led by Infosys. So Infosys is actually at the high point of trade. It's recovered about 2.5% from lows. And the second part, which was the Nifty Bank, which was a weaker, pack for the market, and underperformer, has now begun to improve. So the Nifty Bank should come up for you. We've seen a swift recovery in the Nifty Bank as well. The Nifty Bank has moved closer to the high point of today's trading session, and that's led higher by HDFC Bank. So HDFC Bank, along with Infosys, has led both the Nifty as well as the Nifty Bank higher. And we have ITC, some support coming in from HDFC, HUL and Maruti. So a bunch of stocks also supporting the recovery of the market right now. So let's get in, some perspective from the FNO standpoint. The Nifty has been holding on to the lows that we've seen over the last few trading sessions. In fact, yesterday's low was 17,761, just below the December 2022 low of 17,774. And today's low is exactly 17,774, from where we've seen this big recovery. The recovery has been led by the IT index. So if you just take a look at, the line chart of the way the IT index has panned out in today's trading session, that'll tell you that there has been some support coming in from there, primarily because of Infosys. The second part is the Nifty Bank. Now that the Nifty Bank has recovered as well, it had faced some resistance yesterday at the 50-day exponential moving average, 42,358. So that is one mark that I will keep an eye out on. And as that happens, just also watch out for the 17,900 call and the 18,000 call, because there has been a fair amount of writing at the 17,900 call as well as the 18,000 call. So will we see, some sort of resistance closer to 18,000, or as we have seen over the last few trading sessions, or will there be a case for short covering? That we'll know only once the Nifty Bank as well as the Nifty IT moves are clearer for everyone to watch out for. And finally, just watch out for the 17,800 put. The fact that we've maintained the lows tells you that bulls have it in them to go ahead and defend all the levels that the market is facing, closer to the December 2022 low of 17,774, and the market's spiking to the high point.
Okay, all right, Manglam, thanks very much for that. So in fact, there is a recovery of around 100 odd points plus on the Nifty on an intraday basis. Good time then to get Prakash Kaba in to discuss the technicals of the market. Prakash, hi, welcome to the show. Afternoon. What would you strategize in terms of the recovery that we're seeing? Would you play into this recovery? And what would your call be, both on the index as well as stocks?
Good afternoon to you. Well, so far when I look at the index, yesterday we saw an interesting phenomenon where Nifty saw a new low, but the Bank Nifty did not. There was a diversion of sorts that indicated some kind of a strength. So Nifty, to my mind, Nifty and Bank Nifty both look okay to me. I think it's going up. Today we have support somewhere closer to 17,700 or so, and looks like it should go up higher from here. The next technical targets perhaps could be in the vicinity of 18,000. May take a day or two for that, but looks like 18,000 is on the card. When I look at the Bank Nifty, tells me it's up, and possibly once we cross 42,300, then we will be in safer end. that's a zone we could find some kind of a resistance. So 18,000 on Nifty and perhaps 42,300 or so.
All right.
Stocks
And
yeah.
go ahead for the individual stocks,
I like
Prakash.
HDFC Life. That looks good to me. It's seen some kind of a correction. Perhaps it can go up from here. It's trading at 605 or so. Stop below 600, just 5 rupees. On the upside, the target could be in the vicinity of 615. So HDFC Life looks good to me. Second stock that I like and showing traction is Grasim. Grasim has shown some kind of a low 3 trading sessions and seen a good triple bottom out there. So possibly it's trading at 1670, stop below 1660, just 10 rupees. On the upside, a target of 1700 is possible in Grasim. So yes, Grasim and HDFC Life.
All right. Grasim and HDFC Bank are the stocks that you like. Just finally, before we let you go, Prakash, do you have any thoughts on Bata? Bata has been moving down on, fair amount of volumes. Actually, we don't see such kind of moves on Bata without any news following it. So it can be an unusual mover, so to say. What are your thoughts on Bata? Chartically, is there something that's amiss?
See, Bata was trading sideways, showing some kind of accumulation, but actually it turned out to be a distribution. And it broke down today. Bata has broken down 1620 zone, which is weak, and possibly we'll see lower levels. Can it slide down to 1500 zones? Possibly it can go there. Can it find support there? We don't know, but looks like 1500 is on the cards in Bata. If someone wants to short it, short it. Have a stop above 1580, short Bata, and who knows where it goes.
Okay, all right. Who knows where it goes? 1500 is your target on Bata. Prakash, thanks very much for joining in and speaking with us. So that is the technical calls coming in. Just watch out for Marksons because that one has been an outperformer the entire week. The stock is down 2% but on a week-to-date basis, it's rallied over 12%. Remember, there is that board meeting which is taking place next week on the 20th of Jan, and they will be considering and allotting equity shares against convertible warrants. So that's expected to take place next Friday. So do watch out for that particular stock. We'll take a short break, but on the other side, we'll be focusing on stocks from the IT space, which are reacting to not only earnings, but also news updates. Welcome back. Well, there are a lot of numbers which are due today, but the big one from the financial space, which is really going to kick off the banking numbers, is HDFC Bank, which will be releasing its numbers tomorrow. Remember, their Q3 business update had already given an indication that loan growth had disappointed. It had, in fact, come in at the weakest that we've seen in probably a couple of quarters. So that would be a key trend to watch out for. But overall, there is an expectation that the net interest margins could probably expand year on year, as well as Q-on-Q. But talking about frontline stocks, Infosys and HCL Technologies reported better than expected earnings, but one-offs boosts and macro concerns cloud the outlook for FY24. Reema's here with the fine print.
Thanks so much for that. So Infosys has made a pretty good recovery from the day's low today, so it's now back in the green. Well, when we talk about the numbers, there was a beat on the top line. The revenue growth was higher than what the street was anticipating, and it's also better than what its peer TCS has reported. Margins have come in as a bit of a miss because they haven't improved. They're flat on a quarter-on-quarter basis despite the rupee depreciation. What the street like is the upward revision in the company's full-year guidance. Revenues are now estimated to be between 16 to 16.5% for the full year, higher than the 15 to 16% that they had earlier guided for. And the other big positive in the numbers has been the deal wins at $3.3 billion. This is significantly higher and come in on a quarter-on-quarter basis, and it's also the best that we've seen in the last 8 quarters. Now, HCL Tech's numbers are actually a beat, right, on revenues and margins. HCL Tech's 5% top-line growth is better than what the street was anticipating and better than what TCS as well, as Infosys had reported, and plus margins improved by 165 basis points. Well, a couple of reasons why the stock could be under pressure today. One, yesterday the stock was higher in anticipation of good numbers. Two, the beat on the top line was attributed to the products business, which had a 30% growth in the quarter. Next quarter, the products business revenue is likely to moderate. So the street in a way is discounting the beat because despite the Q3 beat, the full year growth numbers have not increased for the company, which indicates that Q4 is still likely to be a bit muted. That said, deal wins for HCL Tech were also fairly steady.
All right, some more earnings and news. Scientists in focus today on the back of a strong performance coming in the third quarter. The dollar revenue for the company surged nearly 13%, while margin has expanded to 13.2% from 10% in the previous quarter. Earlier today, we spoke with Krishna Bodanapu, who's the MD and CEO of the company. They were talking about their performance in Q3, but importantly, their outlook for the future as well.
Of course, there are certain industries like semiconductor which are slowing down a little bit, and we just will mitigate against that. But some of our large industries are doing quite well. Therefore, from a demand perspective, at least that 3.5% number that we see, at least that demand, we will see acceleration of that. We'll actually see meaningful acceleration of that. We're quite confident that within the next year, we'll at least get to the mid-cap average.
Okay, well, time for a break now. But before we do head into a break, here's something that you, our viewers, must take note of. CNBC-TV18 and the National Stock Exchange have come together to promote investor awareness through a special campaign, Informed Investor, that empowers you to make the right decisions with your money. Nothing in life is guaranteed, but many investors fall for the guaranteed returns gimmick. A smart investor always avoids investing in such schemes and is aware that they are illegal and must be reported to any exchange. Any investment in such schemes is not eligible for compensation from the exchange. Hence, it is wise to avoid investing with anyone promising guaranteed returns in the securities market.
Well, let's talk about the top F&O loser today. It is L&T Tech Services. It's set to acquire the smart world and communication business of its parent, L&T. Rima tells us more on that. Rima, what is the street worried about?
Thanks so much for that. So L&T Technology today has announced that it will be acquiring Smart World and the communication business of its parent company, Larsen & Toubro. With this, LTTS offerings will be expanded in the next generation communication, that's 5G, sustainable spaces and cyber security. But the stock is under pressure today. So a couple of the reasons are, one, the acquired company, Smart World Communication, SWC, has lower margins. The EBITDA margins of SWC are just 8 to 10%, which compares with 21.5% EBITDA margins that LTTS enjoyed last year. So in the near term, according to the management, this acquisition will be margin and EPS dilutive. Second, this transaction is also a material related party transaction because LTTS has acquired the business from its parent company, L&T. And third reason is 1/3 of the cash, which is on the company's books, will be used for this acquisition. LTTS will be paying about 800 crore rupees for the acquisition. And if you see the September, as of 30th September, which is the latest reported financial numbers, the cash on LTTS's books was nearly 2,400 crore rupees. So 1/3 of the cash will be utilized for this acquisition. That said, LTTS is a cash generating business. It generates cash every quarter. And the company said that the dividends are not going to be affected, but just right now, some cash is going to be utilized. That said, despite the acquisition being margin and EPS dilutive in the near term, over the medium term, the company has reiterated that L&T Technology holds on to its EBIT margin guidance of 18%. So they're quite confident that they will be able to scale up the lower margins of SWC and bring it at par with LTTS's margins.
Okay, all right, Rima, thanks very much for that. In fact, we also spoke with Amit Chadha, who's the MD and CEO of L&T Tech Services. Listen in to what he had to say on this acquisition.
I would like to confirm that in the medium term, this will be margin accretive and EPS accretive. But as you would agree with me, with such a large transaction at about 1,000 crore rupees, about 110, 120 odd $1 million, with EBITDA of 8 to 10%. In the immediate term, there could be a little bit of a dilution, but medium term, we are reaffirming our guidance of this being margin accretive. We had committed, and I'm reaffirming that, we had committed in September 21 that we would be $1 billion run rate by FY23 Q2, Q3. We delivered that in constant currency in Q2. We had committed to an 18% EBIT trajectory, and we were able to achieve that right somewhere in that FY22 range, right? We didn't have to come to FY25 for that. We are reaffirming our 1.5 billion guidance by FY25 and being in that 18% range in the same period in EBIT terms.
All right, so that was some management commentary coming in on this acquisition from LTTS. We'll take a short break. On the other side, we will continue our conversation on the commodity space. Manisha Gupta actually joins in with PR Somasundaram, who's the regional CEO India of World Gold Council.
Welcome back. Joining us on the show is PR Somasundaram from World Gold Council. Som, hi, good to have you. And what a last week for gold it has been. We're looking at MCX gold at around 30-month highs. The COMEX gold price is trading at an 8-month highs. And the financial advisors who had not recommended gold to be a part in portfolio in last 1 decade suddenly have turned around, have showed their love for gold. And why not? Because gold prices have gained by nearly $300 in last 3 months itself. What's your sense on what really is happening across asset classes?
Well, as I said, gold has been a best performing asset class in some messages I saw for 2022, and it continues to now suddenly go up, which is something we've always expected, that the gold price will bounce back once these rate hikes are behind us, or at least part of them have been considered. So that's exactly what is happening. The uncertainty, everything is now playing out. The fear of recession is still continuing, global recession. So that is what is driving the gold price.
So, when you look at the Indian import figures that came in yesterday, we've seen December see 20 tons of import as compared to 95 tons that we saw in the previous year, the same month. What really seems to have, battered this one?
Yeah, as you know, Manisha, last year was one of the best quarters, 345 tons. We've never seen that kind of a demand ever in our data series, 25 years. It's primarily to do with the fact that people came out, and we discussed all those reasons. People had lots of money to spend, the lockdown was completed, all that stuff. This year, we did not expect the quarter to be as good as that. So, but what happened was the trade generally believed that it would be equal to that, which is why they stocked up a lot. And when they realized that the demand was good but not as good, the imports have got, reduced. And also, what we hear from the market, we don't have information, is that there's quite a bit of the grey market activity which has now picked up, which is also probably one reason why the market is in deep discount. So that's also a reason for the imports to be very low.
Oh, well, so yes, you clearly have more track of data, but I don't remember the last time you saw a deep discount continue for such a long time. It's been almost a couple of months that we're in a discount right now. Anytime soon that you see this one easing away?
Well, at the current duty of 18%, total taxes of 18%, unless that market is very tightly controlled by the trade or by enforcement measures, I think you should expect this to continue. Also, the demand is at these price levels. I don't think the demand will come back in a hurry.
As you mentioned, so almost everybody's talking about gold right now, and there are various reports doing rounds of 5 reasons or 10 reasons on why gold should be in your portfolio. What is the reasoning that you would give for gold to be a part of a portfolio?
Well, you should never look at the current price, but what the current price tells you is that whenever there is any kind of a stress, any kind of uncertainty, even in the best of times, people turn to gold. And that is one good reason for you to have gold as part of the portfolio. Not just you should increase the portfolio, the allocation to it, but what happens is in such times, it is always good to be very disciplined. Add gold to your portfolio.
While we all understand on how the central bank buying has been pretty high on the higher side in the previous year as well, China buying has been on the higher side. So has been the case with Russia as well. Do you see that trend continuing this year, one? And two, while we have seen 700 tons of gold imports in the previous year, what's your sense for this one?
Well, one is central bank buying. We expect it to continue. We did a survey early part of 2022. Most of the central banks were very positive about continuing to buy. So how much they're going to buy, we don't know, but whether it will be as good as 2022 is also not known, because this year, Q3, there's been a significant jump. 300 tons was bought by one central bank. Whether that will continue, we do not know, but it is going to be another year where central banks will continue to buy gold. That is for sure. And when it comes to the next, what was the second question, Manisha?
About the kind of buying that we will see in India, the kind of imports that you may have penciled down?
Yes. For 2022, as I said, it will certainly be lesser than last year.
Okay.
Clearly, because last year was 800 tons, it should be lesser. If the demand continues, the price continues to rise, we may see this trend of slow demand continuing for 2023 as well, first half.
All right, so the numbers may not be so strong when it comes to the Indian buying, but the price is definitely headed on the higher side. That's at least what the banks and brokerages as well tell us, to expect all-time highs in this year when it comes to gold in dollar as well as rupee terms. So as always, thank you so much for joining us with your sense on gold there. With that, it's out of time on the show. Our business lunch will take all the action forward.